IFRS 16 leases, initial recognition, recognition exemption. IFRS 16 paragraph 22 states, at the commencement date, a lessee shall recognize a right of use asset and a lease liability. So when we have concluded that the contract is a lease per IFRS 16, the lessee has to recognize a right of use asset and a lease liability. That would lead to a debit, right of use asset, and a credit, lease liability. However, under IFRS 16, paragraph 5 to 8, the lessee may elect not to apply paragraph 22 to 49, but it's under very specific circumstances where the lessee would have this option to elect the recognition exemption. Under IFRS 16, paragraph 5 to 8, the lessee may elect not to apply paragraph 22 to 49. What does paragraph 22 to 49 say? Those paragraphs says, when there's a lease, the lessee must recognize a right to use asset and a lease liability. But now, under these circumstances, the lessee may elect not to do that. What circumstances would that be? First of all, this recognition exemption is applicable or available on short-term leases and also on leases for which the underlying asset is of low value. When is an underlying asset of low value? If the lessee can benefit from it on its own or together with other resources that are readily available, and the underlying asset is not highly dependent on or highly interrelated with other assets. So you can pretty much use that asset all by itself, but it's also of low value. When the lessee has either short-term leases and or leases where the underlying asset is of low value, then the lessee may elect not to apply paragraph 22, where you have to recognize an asset and a lease liability for that lease agreement. In paragraph B3, there's some guidance as to what is considered to be the value of an underlying asset. First of all, it is referred to the asset when it is new, regardless of its age. You need to assess its value as if it is new to determine whether it's of low value. And the assessment is also based on the absolute value of the asset. Examples of low value underlying assets is usually your tablets, your personal computers, your small office furniture, and some telephones. Lease payments associated with these leases shall be recognized as an expense on either a straight line basis over the lease term or another systematic basis. So instead of having to record a right of use asset and a lease liability, where the lessee elects the recognition exemption on low value as underlying assets and short-term leases, these lease payments will be recognized as an expense. The election for short-term leases shall be made by class of underlying asset. The election for low-value underlying assets can be made on a lease-by-lease basis. What is referred to as short-term? If you refer to the Appendix A to IFRS 16, the definition of a short-term lease is given as a lease where at commencement date the lease term will be less than 12 months. Also referred to the definition again of an underlying asset. Class example 5 looks at accounting for a lease for which the underlying asset are of low value. Giggly Limited entered into a non-cancelable lease on 1 January 20X9, which is the commencement date of the lease, to lease 10 desktop computers, which are considered to be low-value assets, for its employees. The financial reporting date of Giggly Limited is 31st December. This contract is a lease per IFRS 16. The following information is available relating to this lease transaction. The initial period of the lease is 6 years. There is an option to extend the lease for a further 2 years, i.e. to a total of 8 years. At the commencement of the lease, Giggly Limited has sufficient economic incentive to extend the lease, and therefore it's reasonably certain that Giggly Limited will exercise this option to extend the lease agreement for the additional 2-year period. The lease payments are payable monthly in arrears, with the first payment payable on 31st January 20X9. Years 1 to 4, the lease payment is R5,000 per month. In years 5 to 6, it's R3,000 per month. And in the 2 option extension period years, it's R2,000 per month. 10% of each monthly installment is to cover maintenance costs incurred by and to be paid for by the lessor. So immediately you have one payment consisting of a lease component and a non-lease component. Remember to exclude the non-lease component. The benefit of the 10 desktop computers to Giggly Limited remains unchanged. Giggly Limited elected to apply the recognition exemption in respect of low-value assets to this lease contract. Refer IFRS 16 paragraph 5. Because Giggly Limited elected the recognition exemption to this low-value underlying asset lease, it's not necessary for Giggly Limited to recognize a right-of-use asset and a lease liability at initial measurement. Instead, the lease payments will be recognized as an expense, but on a straight-line basis. For purposes of calculating the straight-lined amount or equalized amount, the following calculation is necessary. The total amount payable in years 1 to 4 is R5,000 per month for 48 months because it's 4 years. Years 5 to 6, it's R3,000 per month for 24 months because it's 2 years, and because it's certain that Giggly, or reasonably certain that Giggly will extend this lease for a further 2 years, we included in the calculation of our straight line amount R2,000 for 2 years, 24 months, and we have the total lease payments over the period to be $360,000. But included in those amounts is an amount in respect of maintenance being $36,000, which represents 10%. If you exclude the $36,000, the lease component amount is $324,000. The period of the lease is 8 years, so to straight line that amount, you get to $40,500 per annum, which is the $324,000 total lease payments equalized straight lined over 8 years. The general journal entries for years 1 to 4 would then be as follows. The lease expense recognized in profit or loss will now represent that equalized amount of $40,500. The maintenance expense, being the 10% of the actual expense paid, is recognized through profit or loss as a maintenance expense. That would be the actual payment of R5,000 for 12 months at 10%, giving you the $6,000 expense. Remember, we said the non-lease component is split out and it is recognized as an expense when incurred. The amount that the lessee will actually pay is represented by the $60,000. That is recognized and calculated as the R5,000 for 12 months. That is the actual lease payment that the lessee will make. But when you now look at your journal entries, you can see because the equalized amount is less than the actual amount paid, it results in a prepaid expense that has to be recognized by the lessee. The journal entries for years 5 to 6 will be as follows. Again, we recognize the lease expense through profit or loss as the equalized, the straight-lined amount of 40,500. The maintenance expense is the actual 10% of the actual expense for that year paid to the lessor, representing the 3,000 for 12 months at 10%. The amount recognized against bank represents the actual amount paid, which is the 3,000 Rand for 12 months, giving you 36. In this instance, the actual amount paid is now less than the equalized amount, but please note we now recognize that difference as a credit against the prepaid lease expense. So you're really utilizing this prepaid lease expense that you've created during years 1 to 4, that is now being utilized during the years in which the actual payment is less than the equalized straight-lined amount that's recognized through profit or loss. You do now not recognize a sundry liability account. You use the prepaid lease expense account. The same will happen then in years 7 to 8. The lease expense through profit or loss is the straight-lined amount. The maintenance expense is 10% of the actual lease payment. The bank entry is the actual lease payments paid to the lessor, 24,000. And again, because your amount paid is less than your lease expense, you now utilize what is left of the prepaid lease expense that you have created in year 1 to 4. If you now add up the balance in the prepaid lease expense over the 8 years, you will see that the full balance recorded and created in years 1 to 4 would now have been utilized in years 5 to 8.